Thanks for joining us on The Close today. I'm Marilla Fernandez. Markets close in 30 minutes. Let's get to the stories we're following out of the BNN Bloomberg newsroom. Keyera says it's finalized the acquisition of Plains All American Pipeline's natural gas liquids business in Canada for close to $4 billion US. But Canada's Commissioner of Competition is seeking to void the deal over concerns about controlling critical energy infrastructure. The application was filed earlier this month. Keyera has 45 days to respond. Hundreds of Dunkin' locations will open across the country. The first expected to open in late 2026 or early 2027. Now, under this new agreement announced today, Foodtastic will manage market development, recruitment for owners, and operations in Canada. And the Canadian company will also have exclusive rights to develop the Dunkin' brand nationally. Bank of Montreal selling its business trucks, trailers, and equipment finance business to New York-based asset manager Stonepeak. The unit has more than $14 billion worth of loans on the books. The bank expects to use a portion of the payments to take a stake of nearly 20% in the new entity. Terms of the deal were not disclosed, but BMO expects to record an after-tax charge of about $900 million. Here is where we are on the markets right now. The TSX moving to the green today of 97 points so far in the day, about a third of 1%. Moving south of the border, a mixed day there. The S&P is down 17 points so far. The Dow Jones up close to 90 points, or 0.2%. And the Nasdaq down 240 points, or almost 1%. Markets are feeling the heat from higher oil prices and higher than expected U.S. inflation. But earnings have defied the headlines. Let's go to Diana Avigdor on this, portfolio manager, head of trading, Barometer Capital Management. Thanks for joining us today.
Thanks, Marilla. Nice to see you.
85% of American companies have beaten the estimates, and first quarter profits have been surging. What has kept them pretty much immune to what's been going on in geopolitics?
It has been such a surprise, one that has not been seen for many, many, many years, this kind of surprise. How much underestimated these earnings have been because of all the different moving parts, be it geopolitical and how it seeps into inflation, is really a head scratcher. But bottom line is that these companies have had earnings surge 27%. So what are some of the things that could have created this situation? Well, they had lots of cost cutting. Some of these companies have excellent balance sheets. Over the last several years, call it, let's say, since COVID, they've been working lean. There's been a huge amount of buybacks, and they have pricing power. So they've been able to perhaps, manipulate, or maybe that's a negative word, but create a situation where they were able to have the earnings that they do. Because, in the U.S., for example, revenues grew about 10.5%, but earnings growth was 25%, which points to increasing margins. And so far, we've had the same kind of thing in Canada as well. So the companies have pricing power. They're able to make it work so far. Anecdotally, I would just tell you, talking to companies' management, when we talk about labor, a lot of times they say, we don't need to do layoffs. The demographics is such that there is a natural flow off of labor off our payroll. So you see a labor market that's still working pretty well. We do have a problem with youth unemployment, which is almost at 20%. So that needs to be taken care of. But these companies are able to make it work, and they've been very profitable.
Okay, that being said, how long can they stay resilient? The oil price surged again today and showed up in CPI south of the border.
I mean, that's a very good question, and it's anyone's guess. They have not reported that they have increased costs because of this kind of stuff, but they've been able to cut it out elsewhere and be able to generate profits. By the same token, we've had the same fears when we were talking about tariffs and how tariffs are going to affect these companies, and we were expecting them to create the same situation. So companies and certain companies have had the pricing power to be able to handle it. And must mention here that breadth hasn't been excellent. So it's not everybody. Not everybody is doing as well as some. For the month of April, 50% of the index rally has been driven by 6 companies and a few more, but largely. So breadth has been narrow, and you just have to be in the right sectors at the right time. So we are tactical. Back in February, we were 30% cash, and we continue to look at what's working and put the money where it's working.
Okay, you mentioned obviously not everybody is gaining. Pet value plunging after missing estimates. Does that give you an idea or a sign of how consumers are doing right now?
You know, yes and no. I think that a large part of what's happening to pet value, and if you look at the chart, you'll see that it hasn't been doing well for a long time. This is not new for them. Pet value isn't going up because the market no longer sees it as a strong growth company. It's being repriced more like a mature, slower growth retailer under pressure. The company also seemed to lack pricing power. Pet value didn't actually miss expectations. They beat on sales, but margin loss was too large. Gross profit margin declined, impacted by pricing promotions. They have same-store sale growth of 1%. Inflation is around 3%, so they're not keeping up with that. It definitely means people are moving down the price scale. This is a sector that was very much hot during COVID when everybody was home and got a pet. But they are losing market share to, Costco and instead of going and buying your dog food expensive, you just order it from Amazon. So they're losing some market share there. They have to grow online. Over 50% of households owning pets are driven by younger customers like Gen Z and millennials. And I would think that it's much easier for them to just hop on their cell phones and order dog food. Yeah.
Let's talk about a stock that you like right now, NVIDIA, but it's already up to 15% this year. It's record high right now, 220.34-ish. Would you buy it where it is today?
So the stock has just broken out, actually. Yes, it is up, but when you look at its peers or the tech sector in general, it's been actually lagging. With its growth, when you look at valuation, if you put in the growth, revenue is projected to grow nearly 70%, and data center revenue is projected to grow 75%. So if you use PE to growth, as opposed to just PE, you have a more decent valuation there. So it's actually just broken out from very long time resistance and relative underperformance. Tech earnings have been excellent, exhibiting excellent growth metrics. And, the cash flow metrics have not been what everybody was very worried about. They still have good buybacks and margin growth. This is what the market wants to see from the growth drivers. So yes, I think I would buy it into earnings. Now, of course, it's huge numbers and can definitely come in lighter, but, that's even if it comes in at 65% growth, is that not high? AMD is growing at 55-ish, so I think yes.
Okay. Diana, I got to leave it there. Out of time with you. Diana Vigdor, Portfolio Manager, Head of Trading, Barometer Capital Management. Thanks for your time.
Thank you.
Financial technology company Coho has joined the Interact e-transfer service. We heard from the CEO, and that's coming up next. Coho announced a partnership with Interact today. The Canadian fintech company is joining Interact e-transfer service as a participant. It says the partnership will expand choice and innovation for Canadians. For more, we sat down with Daniel Eberhardt, founder and CEO of Coho.
I think broadly the story of Coho is we're trying to take sort of orders of magnitude out of costs out of these businesses and then translate that value onto users. And so this matters for a few reasons. The biggest one is it's when we get to directly connect to Interact versus having to work with a third-party intermediary. That's a lot of savings that then we get to translate onto users. It does create a much better experience directly. And so what actually happens with this stuff is you're dependent on third parties, and then you're dependent on their risk structure, their data structure, a bunch of the technical details. And so for us to be able to directly work with Interact lets us move much faster from here in understanding good use cases and bad use cases. And it's also just symbolically really important. You know, we've been behind from a regulatory competition perspective in Canada for a really long time. And for us to be the first PSP, and then actually this is the first of its kind in the history of Canada, shows, I think, real progress for Interact and hopefully the type of competition conditions that translates to better value for Canadians.
What kind of savings are you looking at with this deal and that you'll be able to pass on?
Yeah, I mean, it's not any one element. It's not like we save 40 cents here and translate that directly onto users. It's more that these things in totality let us control more of our experience, take more costs out of the business, and then those are the ways that we translate. So it's not on a one-to-one basis. It's much more that, you know, doing a bunch of things like this, getting a bank license, building most of our tech stack in-house. These are all things that we think help us control the experience and translate that into paying some of the high savings rates in the country or not charging bank fees, those kinds of things that we already do today.
And why is Interact saying yes to this? What's the benefit for them?
Yeah, I mean, I think Interact, the brief history here is Interact for a long time was largely a functional subsidiary of the Canadian banks. They're really trying to stand on their own and have spun out and are trying to be an independent organization. And so I think this allows them to play in the PSP infrastructure, the payment service provider infrastructure allows them to interface with non-banks in matters like this. And so I think Interact is looking to play a much broader role in payments and in the facilitation of data transfers around those payments with real-time rail and some of these other kinds of things. And so Interact kind of has to work with companies like us, or certainly wants to work with companies like us, because we're pushing the boundaries on so many of these payment rails.
All right. And now you've been talking about trying to work towards a banking license. Does this bring you closer? Are you still striving for that?
We're certainly still striving for it. Things are proceeding very well. We're working very closely with OSFI to make that happen. And the bank license is in the same vein as this, which is to say, you know, if we had a bank license tomorrow, we could pay the highest savings rates in the country, or we could lower our cost to borrow. And hopefully that means that because, you know, Coho is on the order of 250 people and the big banks are anywhere from 40 to 100,000. So the whole notion of these things is we get to do with technology and product experience that translates to value, and then users pick us as a result. So yeah, and then, it all works in totality. You know, I think the fact that we have done this with Interact gives OSFI and the Department of Finance confidence, and vice versa. So you kind of move all these balls forward together.
And when does this go into effect? Is it immediate, or when are we talking?
It's live. We're cooking.
So it's up and running today. So Interact's
up and running today.
You.
Yeah, we've migrated 2.5 million Canadians. That the last of the migration took place about last week. So. And
how has that been, the transition?
Team did a fantastic job. It's not trivial to do this kind of stuff. It was kind of, you know, we do these migrations at night where there's low volume, so the team stayed up all night and made sure the migrations went smoothly. It's a real testament to our team here at Coho as well as the Interact folks, but no downtime, no major incidences, and so it really is cool to see not just this being the first of its kind in Canada, but also the idea that the team did such an excellent job that no user experience was impacted. And, you know, now we're back to work on the next thing. And what is the next thing? Yeah, I mean, certainly the bank license is a thing that we're spending a lot of time on. We launched crypto last week, so that's been a really exciting response to that product. We've got a few more things that we'll announce, but you know, we were public in some of this. The thing that we're kind of consistently playing with is not just the traditional financial products or the new kind of financial products around crypto and some of these other elements, but I think there's a lot of work to do and ways that we can create value in non-traditional financial ways. So, you know, we're exploring a bunch of different ways, testing some of those products today. So I think you'll see, as those things kind of bear out, I think you'll see some more concrete announcements from us there in the next couple of months. Can you talk about some of those things you're exploring? I've recently gotten into trouble for talking about those things, so we're gonna we'll wait until we're green.
And have you had a chance to interact with Coho? How'd it go?
Yeah, it's wonderful. And it is cool to see, on the Interact page, which is something Canadians are familiar with, there's a bunch of big banks and then there's Coho. So it's actually meaningful from a marketing perspective in that millions of Canadians view that page every day. And Coho still has relatively small brand awareness in this country. And so there's real kind of marketing value to this work as well.
Danielle Eberhard is founder and CEO of Coho. Up next, U.S. inflation continues to rise as consumers feel the pressures at the pumps. More in a moment. The annual inflation rate moved up in April for the U.S., fueled by higher energy prices. Our next guest believes the Federal Reserve will maintain its current wait-and-see approach as it weighs the fallout from the conflict in Iran. Let's go to Blake Gwynn, head of U.S. rate strategy at RBC Capital Markets. Thanks for joining us today.
Thanks for having me.
So energy, we know, accounted for a big part of the move, but what else added to it?
Yeah, so there was kind of a known adjustment that was coming basically on some of the things that they had to do around the data blackout when we had the government shutdown. So there was a bit of a technical aspect to it there that we know was kind of depressing the shelter component, over the past month. So that went away. I think that was pretty well understood. I think a lot of people were incorporating it into their forecasts. And you did see the print itself was actually pretty close to consensus. So I do think that, like I said, was baked in. The core services ex shelter, what we often refer to as the super core, that also ticked up a decent amount. But overall, I don't think there was anything in here that really was problematic necessarily for the Fed.
Okay, so core inflation we saw did move up. Does that indicate then a longer trend here?
Again, I don't think it's anything problematic yet. I don't think there was anything in here that's really going to move the Fed off of their current stance. It's still too early, I think, to really get a sense for what the impacts of the Iran war are going to be. You did see airfares, you mentioned energy. We saw those things that we can directly track to that starting to tick up. But I think an important component to the Iran impact is the duration of the conflict. And that's something that the Fed just can't know. It matters whether oil remains high for another 1 month or another 3 months or another 9 months. So that's something they just can't know right now. And so I think it's still going to take a couple months for us to just get a good sense of how these things are going to flow through into not just the energy, but flow through into, kind of core goods and services. But also, I think they need to get some sense for how long, this conflict is actually going to last. And that's something they just don't have clarity on right now.
Groceries have been moving up as they have been for some time. But tomatoes, which get imported to the U.S., are up something like 15%. Are those tariffs still working through?
The tariffs are still having an impact. That's something that has kind of taken a bit of a backseat with everything that's happened on the fuel piece. I do think most are still forecasting some of that tariff-related pressure to start to roll out middle of this year into the second half. So that is something I think is fairly well baked in. But now we have this new uncertainty. And I think if you're thinking about the Fed's stance and kind of where things are headed in the second half of the year, now we're probably much more focused on how this Iran conflict plays out.
Do you think that there is room to move domestic policy in the U.S. to address rising energy prices? I know the U.S. president floated the idea of the federal gas tax and perhaps suspending that for some time.
Yeah, I think mostly through the terms of monetary policy. So I'm thinking mostly about what can the Fed do. This is a very difficult type of situation because this is a very man-made, policy-made kind of inflation pressure. And I think it puts the Fed in a bit of a bind because I think the way the Fed impacts the economy is generally through the demand side of the economy. Their tools, interest rate hikes, really can serve to cool down demand when it's heating up so much that it's putting upward pressure on prices. It's not very well suited to dealing with these type of supply pressures. I mean, hiking rates is not going to reopen the strait and start oil flowing through again. So they are a bit limited in how they can respond or how good how good their tools actually work at fixing supply-related issues that are filtering through to inflation. So I do think they're in a tough spot. I think what it really comes down to is if we start to see the inflation pressure broadening out, if it's really trickling into a lot of core goods and services that aren't directly connected to oil, if you start to see inflation expectations start to rise, that's where I think the Fed is more likely to start using their primary policy tool, which is rate hikes. I think that's where you'd start to see them get involved, but we're just not seeing that yet.
So we talked a little bit about tariffs, which, as you mentioned, have been taking a backseat with everything else going on. Do you think that the administration would consider pulling back on some of the tariffs? We still have sector tariffs that are in place. As soon as the U.S. Supreme Court pulled back the larger tariffs, the U.S. president would back to impose a 10% tariff. So do you think some of the tariff could be pulled back to help the American consumer?
It's possible, but also got to consider it may not be their choice. Courts may be making that decision for them. So there are still court cases rolling through the system on some of the other the other tariffs that have replaced the IEEPA tariffs that were overturned by the Supreme Court. So you also have that option there. Now, as far as the administration ends up doing some of this stuff, I don't know. I think duration again is a big piece of this. If we're still seeing the Strait having very limited traffic, if we're still seeing these price pressures in 3 months, 4 months, as we're heading into the U.S. midterms, let's not forget we've got an election right around the corner. If we're still seeing those into midterms and they really feel like, Republicans really feel like they need to do something to boost sentiment, to give some, to give some price relief, then yeah, I think any lever that they can pull is probably going to be on the table if they're feeling that pressure into the elections.
When does it become too late to do that? Because I'm sure people are already talking about the election in the U.S. more widely, but at some point it becomes too late for them to enact something that'll have a break for American consumers by the time they get around to getting that break. So when do you see that cut off?
It's really tough to say because a lot of that is going to be narrative more than it is actual delivered, price decreases or delivered support. I think one thing that surprised me over the last, 5 years to a decade is really how fast the news cycle moves. Things that you think are going to move the needle on an election 3-4 months out, sometimes those are completely forgotten within a month of the election. So the news cycle and political cycle moves so fast. I would almost go from the other way around, is you could do it too soon and then it just gets lost in the noise and people kind of move on and forget you even did those things by the time the election rolls on.
All right. I've got about a minute left. I do want to ask you about bond auctions and the appetite for them. What has that been like?
Yeah, so this has been a very interesting week. We have 2 supply events. We had a 10-year auction today. We have a 30-year auction tomorrow. U.S. interest rates, particularly in the long end, so 10-year yields, but really 30-year yields are hovering right around these kind of high points that we've seen post-Iran. 30-year yield ticked up above 5% today. That 5% level has been a very, very important level for markets. So yeah, that's something we're watching closely. How we take down that 30-year supply tomorrow is going to be very key, I think, in how we trade around this 5% level and whether that ends up holding as a ceiling on rates.
Blake Wynn, got to leave it there, sir. Thanks for your time. Up next, closing bells on Bay Street and Wall Street. Stay tuned. Here are the closing bells for the end of the trading day. At the NASDAQ, Selective Insurance Group ringing the bell. In New York, AAR celebrating its 70th year and the anniversary of its founding and 45th anniversary of its listing. For the TSX, Lazarita School of Business and Economics, Wilfrid Laurier University, ending the day. You're watching the close on BNN Bloomberg. I'm Marella Fernandez. Here how we ended the day on Bay Street and Wall Street. Kind of a mixed day here in the North American markets. The TSX did end up in the green, started out the day in the red, 151 points by the end of day, up 0.4%. The S&P, not a material move. It dropped 11 points today, and the NASDAQ down 185 points, or 0.7%. Let's get to the movers in Toronto. We're going to start in the red with Pet Value. It dropped almost 14%, or $2.76 a share, to $17 flat. They reported earnings. Jeff Morgan has more on this in just a moment. Moving to Abra Silver, it dropped 5.7% or $1.07 per share, taking it to $17.69. But over 1 year, it's up 470%. Moving to Aecon Group, it dropped 5.5% or $2.92 a share. Let's move over to the green. Arrow Copper moving up today, gaining 10.3% or $4.08. Jeff will have a little bit more on this one as well. Hudbay Minerals, a gainer today. It's up 6.6%, taking the share price to $37.19. And then Paramount Resources, also gaining 5.6% or $1.65 a share to $30.89. So Jeff Morgan is the deputy team leader for the Bloomberg News Equities team, and he joins us now to talk some more. Jeff, good to see you. Let's talk about Pet Value. They had their stock just plummet today, double digits on that earnings miss.
Double digits, worst performing stock in the S&P TSX Composite and hitting its lowest point ever. So a really rough day. This is also prolonging a 5-day slide that has seen Pet Value shares lose about 18% of their value. So it has been a long road down. TD Cowen was out with a note describing how this had been a soft start to the year for the company and really kind of explaining the rough ride that they've had. It's worth noting, however, this is not the only company in the space that has been having this kind of difficulty. Last week, I was reporting on a company called Zoetis, which is in the United States, which is an S&P 500 S&P 500 member. They also plummeted after a rough first quarter, a series of rough first quarter results. It seems right now that that consumers are not spending on their pets. In Zoetis' case, they make medicines for both livestock and pets, and that kind of pet segment of the business was falling. So here we have another example in Pet Value today, where results and specifically same-store sales were a disappointment. A little bit of a decline in what people are spending on their animals.
All right, let's get to a copper. It rallied today above 14,000 a ton. Is that a new high?
That is a new high. That's a record high. We hit a record high over the course of the trading day. Whether or not we ended there, it doesn't almost matter because they lifted the stock so dramatically. You noted both Arrow Copper and Hudbay Minerals, two copper producers, two at the kind of the tippy top of the S&P TSX leaderboard today. So what's happening? One, there's a little bit of optimism in the copper space that there's demand picking up in the Chinese market. China is obviously a great big consumer of metals with their industrial economy. And then the other bit is just that there are some supply disruptions in Africa and Indonesia. And so analysts are now expecting a pretty dramatic copper shortage heading into 2027, all the way out there. So we're seeing that reflected in the price, and equity investors are being rewarded. It's worth noting, copper prices are now up 13% this year, crawling all the way back from a decline when the Iran war started. And the S&P TSX Copper Index, this is the group of copper companies traded in Toronto on the S&P TSX Composite, are up 15%. So slightly outperforming the copper price. They had been down as much, that index had been down as much as 14% in the middle of the Iran war, in the middle of the, I guess, hottest parts of the hostilities of the Iran war. So a very, very sharp climb for the copper companies since those lows and pointing higher so far.
Bloomberg's Jeff Morgan, appreciate the update. Thank you. Let's get to mover south of the border. Bloomberg senior equities reporter there is Bailey Lipschultz, and he joins us now. Bailey, this is PAX Group. They provide aftercare for health procedures, I understand. It boosted its outlook. Tell me more about that.
Yeah, boosting its outlook and really crushing expectations really across the board. You look at the analyst reaction, beating on revenue, EPS, EBITDA well above what Wall Street was penciling in. So it did seem like a strong quarter in that kind of producing a bit of a boost, as you mentioned, for the forward-looking view for PAX Group. As you mentioned, acute care setting. They also own some nursing facilities. So two areas that have been quite hot and continuing to see pretty strong demand here in the U.S. So that's obviously showing up, as you can see. 27% jump is nothing to bat an eye at. And this is a company that went public a few years ago, was kind of battered in its path to going public, though it essentially has doubled from that 2024 debut. So it does seem to be kind of beating expectations and, again, leaning back into the defensive nature of some healthcare and healthcare adjacent industries, as well as, if people need to have treatment after getting surgery, that does seem to be quite strong. And the broader thematic that we've seen here in the U.S. of betting on the growing older generation and ability to spend up for care for elderly does seem to be another boost the company was able to see benefit its top and bottom lines.
Let's get to Venture Global, announced some new deal. Did investors like it?
Yeah, beating expectations, as you mentioned, more deals than were expected. This is a stock that also struggled out the gates going public about 18 months ago. But as you can see, a 14% gain, beating expectations, new LNG deals, really expanding their offerings. A big thing to keep in mind if you look at a 12-month chart of Venture Global is it's nowhere near really its peak from a few months ago when we saw pretty much everything, or a few weeks ago, excuse me, when we saw everything around LNG and energy really rallying. But this did seem to allay the bear case concern for some of the skeptics out there. So all things considered, a positive print for Venture. And as you mentioned, positive updates on those deals. Those are things that analysts were really calling out as unexpected, box ticked. And that's why we saw shares rallying today.
All right, some of the air coming out of chip stocks today. They've been on a run. Any reason for that?
Just a rotation, broadly speaking. We've seen a little bit of pessimism as it relates to kind of expectations on the ability to continue rallying. But as you can see, big pullbacks. Qualcomm down double digits, Intel, SanDisk each down about 8%. This does come after a really robust and breathtaking rally. When we look at the semiconductors index, it was up about 35% in the trailing month. We've seen companies like Intel vaulting up the sizes, or up the leaderboard in terms of the largest S&P 500 companies. So investors may be taking a bit of profits, some technical details potentially at play, but it did seem to be just a day where a little bit more risk off, investors wanting to sell out of or rotate out of, at least today, some of their bigger winners taking some chips off the table. The interesting thing to consider going forward as we get a couple of the straggler earnings results, A, what do those mean? And B, more impactfully, is this potentially a sign of more weakness ahead? Or is this kind of a resetting of a base from a technical perspective? And that'll remain to be seen. But we have been seeing pretty darn strong moves higher for these chip stocks.
Bloomberg's Bailey Lipschitz, thanks for the update there. All right, up next, a bullish outlook for the markets driven by tech investment. That's after the break. With rising inflation and oil prices weighing on stocks, how do you get to an upside target of 8,700 for the S&P 500? Let's go to Jay Hatfield and ask him, CEO, Portfolio Manager at Infrastructure Capital Advisors. Thanks for joining us today.
Thanks, Merle. It's great to be back.
Is there caveat to this upside of 8,700?
There is. It assumes we need to get a rally in rates. So 8,700 is 23 times 27 consensus EPS for the S&P. And 23 times really requires that to be justified if you use a DCF model. Really requires rates to be below 4% or well above. So actually, the 9% increase in estimates since the beginning of the year makes our 8,000 target most of the risks to the upside. So that would only be 21 times earnings. But if we get relief in the straight lower rates, we could get up to 8,700.
Okay. You're encouraged by the 2% annualized growth rate for the first quarter of GDP in the U.S., but how do you look at the CPI numbers coming in today?
Well, we have, in our models, we have two leading indicators of inflation. One's the raw money supply, M0, that's down 6% year over year. But the other one is obviously critical right now is oil. That caused most of the inflation in the 70s. We're up over 50% this year in oil. That bleeds through to core. So we're actually, in the short run, very bearish about even core inflation until the strait gets reopened.
Okay. How much longer do you think the economy in the U.S. and markets can fight off those higher oil prices? We're beginning to see it seep through in the core you mentioned, but how much longer can they really hold off?
Well, we think indefinitely. The key driver of an economy is capital expenditures. Normally, when you have a tight Fed like we have over the last 3 years, you get a collapse in housing, and that creates big layoffs and a recession. we have had not a collapse, but a recession in housing construction. That's offset by an unprecedented 15% boom in the first quarter in tech-related spending. So that's the key driver of the economy. That drives employment, wages. It's going to keep the consumer on track. So it's a very unique economy where tech is a much bigger percentage than it was, say, in the internet boom, because in the internet, you didn't need all this non-tech infrastructure to support it.
At the last Federal Reserve meeting in April, there was a lot of disagreement, probably the most in a few decades. Do you think Kevin Warsh is going to be able to deliver rate cuts?
Well, no and yes. So in other words, it would be ridiculous to cut rates now, and it's not going to happen on this committee. There's 4 Republicans and 8 non-Republicans or Democrats and or hawks. They don't have to be Democrats. And so there's no support, and you do need a majority. So there's no support for rate cuts. There's, among those hawks, some think we should have rate increases. So we need, our bullish scenario requires straight to reopen, oil to plunge to 70, and get really low prints in inflation because tariffs have rolled off. Actually, tariffs are going down for legal reasons and have rolled off. You get oil coming down, which will be deflationary, and the money supply is flat. And it's already below 2, or was below 2 before this inflation. So we think we'll still get rate cuts, but that's only going to be determined by getting the strait reopened, most likely in our scenarios by force, not by negotiating.
Okay, and you have some stock picks also that are dependent on whether the conflict ends sooner than later. If the conflict carries on, you like Amazon, for example, Marvell Technology, Lockheed Martin, so plays on technology and defense.
Absolutely, and energy infrastructure as well. But those companies, I mean, not today, but have acted as safe havens really since the pandemic started. They continue to be safe havens when there's bad news on the war, which is most of the news on the war is bad. So we think those stocks will continue to work. Lockheed Martin is actually strangely back to where it was before the war started, notwithstanding the need to restock missiles and the likely increase in the defense budget and super bullish commentary coming out of the management team there. So that's a really low beta way. I think capital was being taken away from the defense stocks because of this tech boom. But we think in May and June, we're going to have a flatter market, and it won't be just straight up for tech. So some of these lower beta plays, like a Lockheed Martin, will start to work, which have not worked during the April boom.
All right. And if the war does end sooner, you like Bank of America, Microsoft, Oracle, KKR.
Yeah, these are all more controversial picks. So we do think that the bear thesis on Microsoft and Oracle is overdone. Oracle's not going to need to spend nearly as much money as a percentage of cash flow going forward. They're going to get very strong earnings from that spending. And for both Microsoft and Oracle, we think these are mission critical, enterprise-wide applications that won't get replaced by AI. And so we think those stocks will start working. And financials, there's going to be fear during the war that the consumer is going to collapse and we're going to have more credit losses. In the case of KKR, limited realizations from their portfolio. So those are definitely stocks that will most likely not work until after the war is over.
So which of these are you positioning for?
Well, we actually have positions in all the stocks because we do have a diversified portfolio. But we do like to give it good advice and not say plow into KKR now, and then we have 2 months of war and 2 months of no earnings and fears about credit. So we try to give good advice in terms of timeliness. But we do hold those stocks in our diversified portfolios in our hedge fund. So we're not just all in on one of them. But we do have big positions in those tech stocks that have been working. And particularly Amazon, that's a pretty defensive stock. It's half retail. Walmart trades at 45 times earnings. Amazon at 26. Walmart grows at least twice as fast as Amazon. So we think that if you want to be a little bit safe and still have that AI upside, that's a great position to be, particularly if we're correct about the market flattening out.
Jay Hatfield, thank you for joining us. Appreciate your time, sir.
Thank you. It's great to be back.
Coming up, Canadian restaurant operator Foodtastic is bringing back Dunkin's, formerly Dunkin' Donuts. Details from the CEO in a moment. America runs on Dunkin'. That's a slogan of the well-known U.S. coffee and donut chain. Now Dunkin' is returning to Canada. Canadian restaurant operator Foodtastic signing a franchising deal to open hundreds of locations, and the first one could open later this year. We got more from Peter Mamas. He's president and CEO of Foodtastic.
We already own about 1,200 restaurants in Canada. We have several different brands, so we're kind of used to opening stores, and we open about 2 restaurants every single week. And bringing Dunkin' back here, it usually takes us about 6 months from start to finish. So finding a franchisee, disclosing, finding a location, making the plans and building it out. So we kind of see the first few stores opening late this year, early 27.
And where do you see the first ones opening? And across is it going to be across the country, regional?
Yeah, so the first 24 months, we're going to concentrate on Quebec and Ontario. So, we want to build stores in the GTA and Montreal. So we'll be focusing on those 2 major areas, after which probably in around 24 months, we'll be looking to open in Alberta and the Maritimes and BC. So we'll spread across the country.
Now, Dunkin' Donuts has been here before and it left. What makes you think this time will work? And are things all settled in Quebec?
Yes, everything's settled. I mean, that was many years ago. I don't even think Foodtastic existed when the last Dunkin' was here. So we just started this company roughly 10 years ago. And that's the main difference. It's, we bought the Canadian rights. We're a Canadian-owned company. We're based in Montreal and Toronto. And we have boots on the ground. So we're going to have local support to support the franchisees. We're going to leverage all our other brands as far as marketing buys and people on the ground. So I think the support and the Canadian ownership is going to help the brand here make a comeback.
And have you had interest, people reaching out?
Well, it's been kind of confidential, so there has been a few leaks. But honestly, the response we're getting today, I think we're going to probably be able to open one Dunkin' every week in around 12 months from now. So we'll be opening about 50 a year going forward.
And how do you compete with Tim Hortons? I mean, it feels like they have a lock here. What are you going to do different that will get people in?
I think Dunkin' is, Inspire has done a great job revitalizing Dunkin'. It's become a younger, cooler brand. It's more in tune with the millennials and the Gen Zs. So you look at their products, they've got refresher, they've got cold brews, they've got great breakfast offerings. I think we're going to resonate with the 13 to 35 crowd, and that's what we're going to go after. So we're going to try to get all the new up-and-coming beverage drinkers and carry them along as we go.
And with food options with some of the younger people, you're going to go with a healthier fare?
Oh, definitely. So we actually are going to tweak a few of the items coming in from the States. So, being Foodtastic, we're kind of privileged. We have over 7 chefs and 2 drink experts. So we're going to adapt what we need to the market for sure.
And are you worried at all coming in at a time when America's not the most beloved neighbor for Canada right now? Worried about any backlash about that?
Like I said, Foodtastic bought the rights here to Canada, so we are a Canadian company. We're based in Montreal and Toronto. We pay taxes here. The franchisees are all going to be Canadians, so I think we'll get over that. As far as the Canada-U.S. relations, they've been our best friends for decades, and we're having a little turbulence here. But I think in the future, I think those relationships are going to get rebuilt. So, I'll leave that up to Mr. Carney, but I'm sure we're going to be on the right path in the future.
And with the franchise owners, will former franchise owners be back in the fold if they're interested?
No, it's going to be all new people. So, we'll, like we said, we just announced it today. So we're going to see, what the response is, and try to work with our franchise partners. Like I said, we're a Canadian company. We have 1,200 restaurants here already in Canada. So I'm sure a lot of our current franchisees will look at the opportunity to bring Dunkin' into their community. So we'll privilege our existing franchisees first. And
where do you see the numbers at? Where would you like to end up with your numbers with franchises?
Yeah, well, I kind of like this one per week. So within 12 months, we'll be on that scale, and hopefully we could keep it going for decades.
But for now, though, the focus is Quebec and Ontario, and then eventually the Maritimes. You want to go out west. When do you hope to be out west?
Yeah, we think Alberta is a great market. BC's, we have a lot of stores in BC. We're doing great there as well. So we're coast to coast. So we have stores from Halifax all the way to Vancouver, whether it's Milestones or Second Cup or Pita Pit or Quesada. So we have a good base there that we can build on. And how do you see it fitting in with your other brands? I think it's something that we're not into right now. So we have Second Cup. Second Cup's a premium coffee brand. It's doing great. We're growing that brand. But, to compete with the McDonald's and Tim's of the world, we weren't in that space. And we've already brought Jimmy John's over to Canada. That's another Inspire brand. So we kind of found that it would be a good fit to bring Dunkin' back.
Peter Mamas is president and CEO of Foodtastic. Is AI the savior of the office market? From Silicon Valley to Toronto, tech firms are leasing space at record speeds. Look at the numbers in a moment. The era of the empty office may be coming to an end, and we have artificial intelligence to thank for that. Over $500 billion in AI investment is breathing new life into the office market space across the world, including Canada. Joining us to talk about that is Colin Yasukochi. He's executive director at CBRE Tech Insights Center. Thanks for joining us today.
Thank you. Happy to be here.
So over $500 billion in venture capital going into AI, but how much of that translates into physical office space demand?
Well, we've actually seen AI companies lease a tremendous amount of space. That's been primarily concentrated in the San Francisco Bay Area. But in Canada as a whole, there's about 4.4 million square feet of office space that's occupied by AI-related companies, with Toronto being the largest market at about 3 million square feet. So it's a substantial increase in recent years.
You mentioned California, of course. We know the major hubs are there, but are you seeing it spread more evenly to other parts of the U.S. or even Canada?
It is indeed. So we started to see artificial intelligence growth in the office market in about 2024 in the Bay Area. Then it started to increase in New York and Seattle and Boston. And we're starting to see that increase in Canada as well, because it's usually about 12 to 18 months behind what has happened in the Bay Area. And so, again, as I mentioned, Toronto being the single largest market with AI companies. And I would say generally the leasing activity environment has increased pretty significantly. In Canada, 32% of the leases in the first quarter of 2026 have been by technology companies. And so that's been a 10-year high compared to less than 15% the prior year.
Are there any specific reasons Toronto is seeing the uptake? Are there any specific drivers that you've noticed?
Well, I think there's been a big push to come back into the office, over the last few years. And the tech and artificial intelligence industry has been, wanting to have more people in the office every single year. It's increased quite a bit. And I think what ended up happening is many of them found that they did not have enough space to expand because they may have cut back a little bit aggressively during the pandemic.
You mentioned Toronto, of course, being the hub in Canada. Are other markets in Toronto considered at all? Vancouver, Montreal, Ottawa?
Yes, I mean, obviously Waterloo is just outside of Toronto, so that's always been a pretty hot tech hub. But Montreal and Vancouver are the other two markets that we do cover in our report. And Montreal is probably the larger of the two as it relates to tech industry leasing and artificial intelligence companies. And a lot of that is backed by the tremendous universities that are, in those regions in Canada.
Part of the reason, I guess, is because they've moved, as you see, from experimentation to large-scale deployment. Can you expand on that a little bit more?
Yeah, so initially when, artificial intelligence came out, and that was really, I guess you could go back to 2015 when they're trying to develop these types of models. And now that there are baseline models existing by many of the large language model companies, other companies have come in and tried to figure out what problems can we solve using this technology. And that led to a tremendous amount of growth. And investors saw this as a huge opportunity and poured a lot of venture capital funding in. The comparison I'll draw is during the time period when the mobile phone came out. That mobile phone, basically the mobile internet, enabled companies to reimagine, how we would do things, how we would call up a car versus a taxi, how we would book a hotel room. All of those kind of things are starting to evolve as to AI making processes more efficient and leading to new business development. And that's why the hiring has increased pretty tremendously by these AI companies, as is the need for them to have office spaces.
So, Colin, I'm wondering if this is or looks like a longer-term recovery for commercial space. And I ask because, of course, it took much longer than most thought for people to come back to work, reoccupy some of those spaces in downtown Toronto, and I'm sure in other cities as well. Is this very dependent on how long the AI boom lasts?
Well, certainly, when we've seen over $500 billion worth of venture capital funding go into these AI companies, and the second thing we've also seen is a huge amount of capex by public technology companies. That's been over $1 trillion over the last 5 years, and expected to be $4 trillion over the next 5 years. That's a lot of money going into it. And I think that provides us with a lot of capital for growth going forward. But as we've seen in any technology boom, there are going to be some sort of adjustments along the way. But we feel that there's a lot of fuel for growth, and that growth is going to benefit the real estate markets really across the U.S. and Canada.
Colin, I've got to leave it there. I'm out of time. But Colin Yasukochi is joining us today, Executive Director, CBRE Tech Insight Center. Thanks for your time.
Thank you.
Up next, we'll get you Bloomberg's chat with JP Morgan Chase CEO Jamie Dimon. Back in a moment. JP Morgan Chase Chair and CEO Jamie Dimon joined Bloomberg today to discuss the state of global financial markets, inflationary pressures, and the use of artificial intelligence.
I think there's a little bit too much exuberance out there. It's not just the Middle East. It's, it's Ukraine, Russia still there, America, China. There are a lot of these complex issues which may or may not affect the market, but then there are issues like inflation. Today's print wasn't so good. So, yeah, I think the market's kind of exuberant, and it may not be completely justified.
So why are they so exuberant? If they're exuberant, are you expecting a correction? And is it because they're looking at AI?
No, I don't think it's AI. I think corporate profits are doing very well. AI will be a plus. So this year it's just a lot more spending, which may be a little inflationary, too. But it's more corporate profits. We're doing a little bit more QE. Government's still spending a lot of money. The one big beautiful bill is kicking in. Stimulus offsetting a lot of the gas. I think the gas increase, $1 of gas is $100 million. The one big beautiful bill is $100 billion that consumers pay. The one big beautiful bill is $300 billion. Deregulation is real. There are these things which are causing a pretty good market right now.
But when you talk about exuberance, it means that there's a market dislocation. Where do you see that?
It means the stock market's in the top 10, 15%. Credit spreads are very low. The general assumption that these things are all going to resolve. And I'm kind of a skeptic. I don't know. I hope they do, but I don't know that they will.
Okay, what do chief executives worry about in private that they tell you that they won't tell us?
Not much. Trade, America, NATO, the wars, oil prices. I mean, the same stuff you hear about all the time.
But CapEx, I know, we had a great earnings season. Yeah. Is the next one going to be less good?
I don't know yet. It's very hard to tell. I think the deficit spending drives a lot of drives a lot of corporate earnings too. So and drives a lot of capex. And will capex create productivity before it creates inflation? I don't know that. I think one of the risks is inflation. I've always thought that, and so.
But also, how do you think of oil, and how do you think about what's happening in the Middle East? If this lasts 3 weeks, 4 weeks, even like 2 months, are we going to be in trouble?
It's a big deal, and every day it gets a little bit worse. I don't know how it's going to be resolved. I hope it gets resolved in the interest of the United States and against the Iranian regime, not the Iranian people. But I don't know. But I read something today that was very interesting, that China reduced their demand by 5 million barrels a day. America increased its exports by 3 million barrels a day. That 8 million is made up for a lot of what was lost, and which is maybe why it hasn't been as severe as people think. On the other hand, inventories are coming down. Gas wells may have to be closed and stuff like that. So it gets a little more serious every day. That day that it becomes a disaster has been pushed out quite further than we thought at the beginning.
Do you worry about the U.S. consumer? Are you seeing signs of stress anywhere?
No, I think the upper end, the top 50%, lots of money, jobs, wages going up, home prices going up, stock prices going up. They're spending like they should. Like they're buying, they're traveling. The bottom 30% is, I'm going to say, it's struggling a little bit. It's not a massive downturn, and of course we'd like to help them, but their wages have not gone up. But more important than that, they still have jobs, and they don't have too much debt. They still have jobs, and that, at the end of the day, what's going to drive consumer spending, consumer sentiment, that part of corporate profits will be jobs.
What do you worry about? I know there's also the president is meeting with President Xi tomorrow in Beijing. I mean, does that have implications for the trajectory of America?
Look, I don't know, but I would suspect they'll come up with that'll be a friendly meeting with some positives from both sides. I don't think China's going to give in to any major demands. I don't think we're going to make major demands. We both have a lot of common interests. Anti-terrorism, anti-nuclear proliferation. China is feeling its oats. They have to deal with President Trump. So we'll see how it turns out.
Okay, you had an amazing trading, results. The trading was amazing in the last quarter. How's it going now?
Well, I can't comment on that. But, from the last time Troy spoke publicly, it was fine so far, but I can't give you other information than that. So,
give me a sense.
When you guys can see every day, volumes
are high.
And when volumes are high, all things being equal, it will be good for trading.
But you're part of it. I mean, it's you think it's going okay because it depends on the kind of trading that you put, right?
You
benefit.
Trading is going to be very good.
Talk to me about AI.
Yeah.
So I don't know whether you've also played around with Mythos. What did you see?
So AI, big picture, AI is going to cure cancers and reduce work weeks, and kids will live longer, and planes will be safer, and cars will be safer, and less people die, and you'll have new drugs. It's going to be good. We've been using it now for 13 years. It does an amazing job in various different things. So we're going to deploy it to help our customers. There are two attributes that people worry about. One is Mythos. It's legitimate that this is so powerful and covers a lot of vulnerabilities, and we're all trying to figure out how to deal with it, not just for ourselves, but with all of our friends, big banks, small banks, telecom. The government's on top of it, but a lot of the work's got to be done by enterprise. They don't have the ability to do a lot of that. So I think Scott Bessett's running it for banks, and I assume they've done it for other people elsewhere. So we're all getting our hands around it. It is risky. Everyone, and we actually publish, and people should look at this, like a list of what you can do now. Don't wait to get Mythos, because everyone's going to get it at one point, but you can't give it to everyone. If they can't handle it, or if it gets leaked out, it can be used by bad guys before we've protected open source code and all our code. And so we need a little work to do to get it done right. And the other one is this job disruption, where that may be true. We should get prepared for it. We should be breathless, and that to me is, how do you create skills and reskilling? There will be a lot of jobs, and AI, cyber, advanced manufacturing, the trades, and then we should make sure locally, and this is like maybe between government and business kind of collaboration, that we are prepared if it happens too much. Stop talking about it. Have a plan.
But my thoughts, does it change the way that banks have to defend themselves? Are you thinking about cybersecurity differently?
No, banks have always been top of the heat in terms of cybersecurity. I wrote about in my chairman's letter, cyber is our biggest risk, made worse by AI, and that was before Mythos. So this does make it more dangerous. That's why banks are really working this thing right now. And all of us, and together. We're collaborating. We're not like arguing with each other.
What does that mean? What does that actually look like concretely in 5-6 months?
Yeah. All going through our own applications. With Mythos, patching them up. We're all going through open source code. A lot of flaws in open source code. We don't need to all fix the same open source code. If you fix one, I can fix the other. Collaboration. Trying to figure out how to form utilities to help third parties. Going to our critical vendors, including we're hooked into exchanges around the world, making sure they're doing it properly. And there are other things like how do you, a patch used to be posted publicly, and you patch. Fix that patch. Now you have to be able to fix the patch in hours. And some you can't make public. When you make it public, the bad guys will get it, reverse engineer it, and get through. So we're doing all that stuff. It's serious work. I think hundreds of people doing it full time now.
Look, hyperscalers and also funding of hyperscalers is really propping up the economy. Do you have any worries about getting that money back, or some of the funding of what's being constructed?
The way I look at it is that AI is real. A lot of money is going to go into it. That doesn't mean everyone who does it is going to be a winner. Go back to the internet. A lot of people lost, a lot of people won. And so, and the hyperscalers, were those data centers not find use? They probably will. But is it possible that some do it badly, design it badly, didn't get the right? Yeah, of course it's possible. Yeah.
Jamie Dimon is Chairman and CEO of JP Morgan Chase. Coming up, hot picks. We zero in on 3 plays in the restaurant sector when we come back. Time now for hot picks, and we zeroed in on the restaurant sector. Our guest highlighted a beverage company's Texas branch may be going from problem child to golden child. We got more from John Tower, equity research analyst at Citi.
Dutch Brothers is a fast-growing beverage-centric concept, mostly drive-through with a walk-up window. That's been compounding its store growth at a high teens, low 20% clip. That's translating into roughly similar levels of EBITDA growth. They've been penetrating across different markets in the U.S. They started in Oregon and made their way through Texas, and they're still infilling all the way across the East Coast. They've got spots now in the Carolinas and Florida. And the idea here is they're kind of building off of the away-from-home beverage category, starting with kind of cold coffee, but importantly, they've been the leader in energy, customizable energy for the industry. And that's about 26% of their sales mix today. And they've been winning with Gen Z and winning with younger guests, Gen Z, millennials, through ongoing product innovation, great hospitality at the store level, fast throughput and attractive price points. And we see that continuing into the future. The stock has come under quite a bit of pressure, frankly, over the past 12 months, and specifically year to date, as investors have feared McDonald's and other concepts moving into the beverage market, specifically energy, in 2026. I think those fears are overblown. While I think it's a good opportunity for McDonald's to build out that platform in the U.S. and other brands do the same, I think what Dutch Brothers has demonstrated to date is that they've got a capture program in place with their existing customers that constantly brings them back. And frankly, as others highlight the energy market, I think what we're going to see is Dutch Brothers consumers continue to gravitate to that brand, meaning Dutch Brothers, over time, given, frankly, the customization and hospitality that the stores offer. So I think it's great. I think it's undervalued. And as we move through, the summer window, when McDonald's is effectively expected to launch its energy platform, I believe you're going to start seeing Dutch Brothers stock performance really pick up from there as this whole competition thesis gets debunked.
Why were they originally considered maybe a bit of a problem child?
That was the Texas market specifically.
Oh, okay.
Under the old management team, they expanded into markets quickly and didn't necessarily have a thorough strategy on how to attack the market. And what's transpired under new management is a much more thoughtful way of approaching markets. Specifically, they're seeding and supporting a number of these stores with much greater spend around media, social, more than anything else, to try and build brand awareness and frankly, build some customer frequency. And they've got a much better rewards program in place now. So brand familiarity is much higher when they're moving into these markets, and recapture of guests. You try it one time, come back in because it's such a good experience at a reasonable price point.
Got it. Okay, so let's move on to your next hot pick. It is McDonald's. You say McDonald's obviously contending with the same macro pressures as some of its peers, but why do you like McDonald's?
Their balance sheet is phenomenal. I think they've got a number of drivers in place that will help turn around the story in the U.S. And frankly, when they just reported results last week, they spoke to a weaker April. That was one of the more challenging comparisons from 2025. They had a Minecraft tie-in. It was a difficult lap. Going forward, it's going to be an easier path for their sales over the next several months. We're going into World Cup season. They're the official sponsor of the World Cup from a restaurant perspective. But importantly, I think what they're doing now with respect to marketing and product innovation, it's just a much faster pace of both, and frankly, velocity of ideas coming to their menu that will resonate with guests. So right as of last Tuesday, I believe it was, they launched part one of their new beverage platform in the U.S. It was refreshers. Think of just carbonated drinks with a little bit of syrup or dried fruit to try and start attracting different customers for different occasions. Some attach. Next round of this stuff's going to come probably sometime this summer in the form of energy, and they're attacking it at a value price point. It's going to be interesting to see who they win share from. I think broadly the energy market in general and the beverage market in general is just growing in the food away from home category. And I think that's going to help drive some of their business, drive some attach. They've also got a lot more by way of product innovation. I think you're going to see more by way of chicken coming later this year. And then importantly, they're going to step on the remodel gas sometime sooner rather than later. We're probably going to get teased some of that in the second quarter call. We'll get more information in their fall investor day in September, where they'll likely outline plans for the remodel cycle in the U.S. And if you look back, the last time they did this, the experience of the future remodels, it really transformed their asset base in the U.S. and led to a lot of capture of traffic within the industry. And it allowed them to jump well above the competition in terms of how their assets were viewed in the eyes of the consumer, which meant stickier sales over time. So I think we're going to hear from them in the fall with more details, but I think they've got a good path here for multi-year top line growth from a same-store sales perspective. On top of it, globally, they're still growing their footprint in that 4 to 5% range. It's right up there with all the other global QSR brands, and I don't think they get enough credit for it.
Lastly, we want to get to your last one, Chipotle. You believe that there's room for positive growth, positive re-rating with Chipotle. Why is that?
Yeah, look, they've been very conservative with their guidance to start 2026. It even started in the fourth quarter with their results, but they, I think, have set a low bar for expectations. I think what you're seeing here is similar to what we've seen across other brands across the industry, which is there's a much greater pace of innovation and new product news to drive consumers back to their stores. You couple that with more attractive marketing. They are starting to weave some price points into conversations when they're speaking to guests, and they've got a revamped loyalty program. I think all of these things are going to lead to accelerating same-store sales growth in the U.S. You still have high single-digit unit growth and, frankly, measures in place to ensure that all of this marketing and all the investment that they're making on new products aren't necessarily coming at the expense of profits. They're weaving in new kitchen equipment across their system, going to make them much more efficient and, frankly, allow for catering across their store base, which might be a whole new layer of sales growth for them. So to me, you're going to see accelerating same-store sales on a stock that's been hammered for the past year. And accelerating same-store sales in this industry generally translates into improved price momentum for the stock.
John Tower, equity research analyst at Citi. A final look at how we ended the day on Bay Street and Wall Street, a bit of a mixed one for North American markets. The TSX is the gainer today, 151 points up, 0.4%. Not a big move for the S&P 500. It was 11 points down on the day, but then the Nasdaq dropped 185 points, or 0.7%. Some of the chip stocks, which have been gaining a lot of ground more recently, gave a little bit today. And materials, miners helped move the TSX up today. Did start the day off in the red. All right, that does it for us today on The Close. Thanks very much for joining us. We'll see you back here tomorrow.